Good day, everybody. Today is December 27th. Brian here from quantlabs.net. I wanted to talk about one of the most reliable ways to visually gauge market risk. When I say market risk, where we can measure basically the overall health of the global market. When it gets too much, you'll see the spikes. So if you go, probably if you're not a customer of Oanda, you can, if you are a customer, let's say, it's a gold silver ratio. So if you just go in, it's XAU and then XAG, all one symbol. And basically, you can also see it on TradingView as well. So this metric goes all the way back to 2006. And I'm looking at it right now, including today in December, and that's 2022. So we clearly see the financial crisis included in here, and more importantly, by the look of it, is the overall pandemic and the level of spike here. So let's say in 2006, when you had the uh, the panic happen for the financial crisis back in 2008. Just to give you an idea, the value of the ratio here, the gold silver ratio is around 53, let's say. So along comes in August 2008, the financial crisis goes starts underway, and it went up all the way from August to December. I'm looking at a value from 53 to 79. So that's almost, well, over a 50% hike in that amount of time. That's how much there was as a risk. And then as the financial risk tapered, and the lower the number it is, the better. It dropped and it continued to decline from January, uh, from around here, around as high as 84, and then all the way to March 1st, it was down to about 32. So it's even lower than what was in 2006, which is good in a way. But I mean, they spent a lot of money with the tapering and just printing so much money. So now we can see here from 37, 32, that ratio. And over time, it peaked a little bit back in February 2016. So now we're going back to 88. So remember, the peak of this thing was about 88. So now, February 2016, we're already at the risk of the peak financial crisis. Okay. So with all the printing that went on, we have now, especially for the US economy, US debt level, we're back just alone in 2016, we're at the same as the peak of the financial crisis, because back in 2008, the national debt was a lot lower than what it is now. So as they start printing money, and as I said, it peaked again February 2016, so it's up to about 78, 83, and it went down a little bit, and it went down to 70 in July. Then it started to climb up again. This is the gold silver ratio, started to climb again and reached its highest on record. So that's now June 2019 at 92. Now remember, the peak was around, let's say, 88. So now back in 2019, we are at 92. So that's the highest it's ever been since 2006. So it dips back again. And then once the virus started in 2020, right now, or back then, February 1st, I'm looking at this on a monthly view. February 1st, it was already at 85. Okay. And then as the pandemic started to spike, and remember, this is where they closed down the economy. They added what, 5, $6 trillion. Okay, so it peaked now all the way up to 112. That's the highest it's been, and there's a little spike that I'm going to ignore on the candle. but it's around 112. That's the highest it's ever been in the peak of the pandemic, and that's March 2020. So when they started printing money yet again, it dropped it back to in April 2021, dropped it back to 66. So that's roughly the same time as in August 2016. So here's where the danger comes in. As they print more money, okay, it starts to climb again. So we're going from, let's say, March at 65, and now it's starting to move up. Now, currently, March 2022, uh, June 2022 of this year, it's already at 88. So remember, financial crisis in its peak was already at 88. So right now, that's where it's kind of hovering at. Um, the last record I see here is okay. So this is a monthly view. So this is in August. So it's staying at 88. Okay, so it doesn't include things like where they added the omnibus bill, the 1.7 trillion. So it's going to spike again. But either way you look at it, this metric as it climbs, it puts you into focus of where the risk is. So when you look at this year, um, with the invasion of Ukraine, I'm looking at in that was in February. So we're going from December, uh, January, and then till let's see here. So it barely made a blip. So between November 2021, it was at 74. So then you come over to during the peak invasion in March, it really has not changed. So this war has not had much effect on the gold ratio. Now, I've talked about gold on the price of gold, how it peaked in 2022 quite a bit, I think to over 2000. And then since after the invasion in Russia, Ukraine, it dropped back. Now, gold theoretically should stay spiked. It should be sustained at 2000 because it's a safe haven, which really it's not, regardless of all the videos like on Kitco or Stansberry Research. That's a crock, okay? Um, I can get into gold uh, in a little bit, but the major thing is with the gold silver ratio, it's starting to spike again. So the war had very little effect on this ratio. Now going back to gold, gold should be a lot higher than what it is. And a lot of that could be attributed to basically it's manipulated on the trading desks. I have seen gold miners spike. I just did another scan in the markets for the US. No, there's not any top performing gold performers there now. So as the market improves, gold miners drop back in performance as other mining companies start to pick up and start to perform as well. So gold is not a concern right now. It does perform, but it's not a best performer. Here's the problem I have with gold when you store it as a physical product. You got to remember if you have gold as part of your portfolio, they've been talking about collapses for the last 20 years. So let's say we go back all the way to 2006. So we had the financial crisis, it barely budged. It did budge in 2022 with the invasion. And you think that would be a major calamity. But as the markets improved, gold came off and the US dollar started to improve. So investors were putting money into US dollar. That's just another reason why you don't want to hold gold because when you hold physical gold, you're tying up your capital. So let's say if they say you go after 10, 15% of holding in physical gold, the problem there is that it's an opportunity cost because that 10, 15% that you have tied up in gold could be used in other investments. So let's say just in the last month, you could have had and done very well in gold miners, but now they're they've tapered off, and you could have sold off those, taken profit on those gold miners, and moved into other mining companies or other sectors in the U.S. market that are performing. That's also including health, like pharmaceuticals, doing pretty good right now. and you can put capital in there and continuously get performance. When you look at, depending upon the size of your trades, and you're doing it on something like interactive brokers, those kind of commissions would be very minimal because your uh, time horizon on those positions could be a month, it could be 2 months. So your trading is very minimal, and your commission is very low. But where you get the return and you know where to go, you will easily be able to eat those commission costs and not really see it because performance you get in a month on certain stocks that perform well, you could get 5%, 10% in 1 month. You will not get that when you hold gold. It won't matter if it's physical or a derivative product of gold. You're just not getting those movements. So why tie up that capital, which is called an opportunity cost, where you could get better performance with other sectors and be able to get better performance. Now, here's the thing. This is a smart way to invest. If you're following, as I said, the Kitcos, the Stansberry research, there are some people that are okay, but the worst one of all is Peter Schiff. Like he's really like I just saw a 45-minute video with him on, I believe it was Stansberry or Kitco, one of the two, but he was outright lying on the data that I was seeing, and he was contradicting what I was seeing. So either he's really dumb or he's lying through his teeth, and he's just a dangerous person to follow. Another person I used to follow is Max Kaiser. He was pretty nasty with that Daniela on Stansberry Research, so cut him off. He's dangerous to follow if you want to just lose money. Continue following him because he's all in with like Max, the Bitcoin maximalist, and Bitcoin will come back. I don't know when, but it's definitely not performing right now. But in terms of risk, watching the market again, the gold silver ratio is really good. XAU, XAG is a symbol name. You can get that on Oanda. You cannot get that on interactive brokers that I've seen. I do believe there's a ETF that kind of follows this, but I wouldn't do it. Um, you're better off if you don't have access to Oanda, just go on to TradingView and use that. It's free, and use Oanda as a data source. So you can do that as well. But this is a very reliable indicator. It does show that there is risk growing in the market. As I said, it's all due to inflation, and that inflation is due to interest going up to fight inflation. But the root cause of it all is basically national debt. If you've taken old school economics 101, it's quite clear two things will happen when you have a slowing economy and debt rises. National debt rises. You get inflation as a punishment for carrying debt, and the other punishment is taxes needing to be raised on that. So I've already gone over that one of the previous podcasts. I believe I put out in the last week, and it's very dangerous times right now with what the U.S. government's doing. They're outright lying and misconstruing the real data. How do I know that? There's lots of data sets that were set up by the Federal Reserve since the 30s, 40s, and the 60s. And what happened was in around 2010, 2015, in around there, they discontinued a lot of those data sets that they had tracked for 50 plus years. And all of a sudden, they started to uh, use new data types that starts from 2010, let's say, or 2012, 15. That's because they're trying to hide the real horror stories of the old data sets that are not no longer being tracked. But you can clearly see those data sets over 70, 80 years of what's going on. But because the debt's so bad, they have restarted new data sets and no longer updating the old data sets. The other thing is with the Federal Reserve, which are a bunch of crooks, in my mind, is how they define what a recession is. There's a difference between a recession on metrics on the economy with the GDP performance, as well as two negative quarters, and they were trying to basically confuse people because of politics to make themselves look better. And unfortunately, that confuses people. But the old school way of defining defining basically the world of debt and these data sets that you use so-called can get for free on the Federal Reserve, St. Louis Fred site, uh, yeah, it stops and you'll see if you know what to look for. But at the end of the day, that doesn't really matter. What you should watch on a monthly basis, like what I'm doing now and explaining, is this gold silver ratio. It for right now, from what I've seen, it's absolutely the number one reliable source. So, knowing all this information, the question will be, what do we do with it? What will happen? There's not much what you can do at this point, but just be aware that when you watch this metric, this ratio, gold silver ratio, you will see how um, it is climbing. And as I said, it's because of national debt, and they just print money like drunken sailors with a credit card, and they don't really care. Back in the day, they would go austere and cut back lots of programs to reduce debt and reduce these deficits. But they're not doing that anymore. Not in the last probably 6 7 years, since 2016, we'll say. And they just print, 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 print. So what will happen in the future? There will be some sort of catalyst coming. I don't know what it will be. War, a collapse of something major. Um, and I'm going to do another podcast on inflation and what I see there. But in essence, what I can say, the inflation has peaked. Okay, like the inflation has actually gone down quite a bit. But whatever you listen to on your financial news, they're putting a scare on people, and this is the worst about Peter Schiff. Go, oh, it'll keep going up. I see no evidence of that, but I'll leave that for another podcast. But that's not where the problem is. It's going to be currencies, the credibility of the U.S. dollar, and the credibility of the U.S. government, which is going out down the toilet right now. And we have no control over it. What goes on in the West is scary. But I'll talk about another where things will be in in another episode. But thanks for listening. If you want to know more where to put money safely, uh, just get on my email list, quantlabs.net/books. I'll get you a PDF there for that. And that's to show you some trading tech tools. And you can learn more about what I do. We do live webinars every Monday night, Eastern Standard Time. And we'll leave it at that. Thanks for listening. Have a good day.